we believe that euro and yen must remain undervalued against US dollar in order for Europe and Japan to reindustrialize. I think it would be a very big mistake from central banks, because for FX is mainly driven by central banks. It's a short-term rate animal, FX, and that's the reason why you see Kuroda and also the European central banks. They will change their mind. They will try to avoid too harsh forward guidance, because I think they understood that in a reindustrialization race, you are very favored if your currency is not too high. So that's the reason why they will try to keep the euro and the yen undervalued. But the big issue is that even though central banks say things along the lines, so we're going to do that, and finally they don't do it, what we've seen in '85, the famous Plaza Accord 2, first by the US, is possible if the US government or the US Treasury believes that the US dollar is too high. And it's going to be complicated for Europe and Japan not to accept a weaker dollar. So that's the big risk that I see for European and Japanese economy, is that at a certain point in time, we see a much weaker dollar that is engineered by the US Treasury, and like it happened in '85, and like it happened in many instances along the economic history. And the dollar is our currency, but it is your problem. This is what the Secretary of Treasury said, Mr. Roosevelt, in the 50s said about the dollar. So that's a very key point to have in mind. So what I was talking about increasing the risk is not because for the sake of increasing the risk, but the thing is that financial repression will carry on. So that means that institutions will try to force savers to buy bonds yielding below inflation, because this is the only way to reduce debt. If you look at debt to GDP, which is the major mark that is assessed by markets when it comes to dealing with the debt, they look at this famous ratio, which is debt to GDP. GDP being nominal GDP, so that's the reason why keeping high nominal GDP will help government in dealing with their debt. What you have on the numerator is the debt servicing that is currently very low, and I think countries and governments will try to keep this debt servicing as low as possible, and this is the objective of financial repression, forcing investors to buy bonds that are yielding below inflation, and this is deficit. So servicing of the debt plus deficit on the numerator, and on the denominator, this is real GDP. And I think that in order to nurture a strong nominal GDP, you need to do a bit of deficit. You need, even though it's hidden through state loan guarantees or things like that. It's still that you're going to get a high deficit. And that means that you have to deal with your debt servicing. You have to keep your debt servicing below inflation. And this is the reason why bonds will, in this new environment, will not be the best asset as it has been for the last 20 years. Very low returns, most of the time below inflation, as it is the case right now. Capital gains very limited because we won't see strong decrease in rates. So all of that in the current technical environment investors are in, so meaning that they have to deal with risk indicators, investors will have to keep long bonds in order to balance the risk. Buying risky assets will lead to buying some bonds. So increasing the total risk of the portfolio will lead investors to have to need an amount of bonds that is much lower than it would have been in keeping or in reducing the risk. You reduce the risk, you have to buy more bonds or to sell assets, risky assets that are basically, if you look at equities over the long term and at the first order, they will deliver something like the nominal GDP. I think equities over the long term, they deliver nominal GDP. So all of that is really advocating for a slightly higher risk in order to not be forced to buy too much bonds. So central banks will support it, and when I said that they will wimp out as soon as growth slows down, so you're going to see that. I think they cannot afford any kind of credit events, and we'll be back in the 70s. But it's not stagflation. It's not stagflation. It's strong nominal GDP. It's very different. Strong nominal GDP that is engineered by government-led investment will lead to stagflation ultimately, but much later, like it was in the 80s. And I just quoted Edward Burns, so I quoted Alan Greenspan, but Arthur Burns, who was the chairman of the Federal Reserve in the 80s, at the end of the 70s, when he was asked the question about his track record and the fact that unfortunately he failed to keep inflation under control, he said, "But that was not my goal. My objective was not to keep inflation under control at any rate. I had to deal with the war, the Vietnam War, that I had to finance, and some kind of society projects like dealing with equality or things like that. So it means that my goal and what I was told was not to fight inflation at any rate. And this is that I think over the medium term, this is what central banks will convey as a message. They say inflation will converge in the first place, and there is a high probability that at a certain point in time they will have to change, the central banks, the inflation objective in order to deal with that new environment. So short-term dynamics at that current level, bonds offer little to no value. Return to negative correlations between bonds and equities. This is the next one. Is key in order to find marginal buyers of bonds. I think this is key to engineer negative correlations between bonds and equities. So maybe to engineer a couple of shocks in order to keep that correlation alive. USD, we've been saying that for a while. USD is peaking, and we still believe that high-yielding currencies, they really offer the best risk rewards. I will say that along those lines. All the West is doing the same. The G4 is doing the same. The G10 is doing the same. So the dollar has got the same. The over G10 currencies, they have the same disease as the dollar. Not that different. This is not the case for most emerging countries who have not printed that much money during the COVID crisis, or where they have positive real yields in many emerging countries where yields are much higher. And all of that is advocating for a strong performance of emerging currencies, which at a certain point in time will lead them to be overvalued. And this is where they are overvalued, like they were in 2013, for instance. This is where you have to get rid of them. But this is not the case yet. For sure, in that environment will lead, the policies, I would say, will lead to a very different kind of market environment. If I can summarize this new environment, I would say that it will be different in the way investors are treated. Beforehand, investors were very treated for the last 20 years because its performance has been great, but you had strong periods of dislocations. This is what happens when you risk deflation. And when you have deflation, this is dangerous because you may have, if real growth is negative, you may have negative nominal GDP, which is no longer doable in a world economy that is massively leveraged. And this is the reason why most central banks, they kept inflation target at 2%, because they have a 2% cushion before getting to negative nominal GDP. So that was the main problem with investors, is that we have to avoid getting into negative GDP territories, because then the financial world will explode. And that's the reason why in 2008 we had major injections of liquidity, not as much as what governments did in 2020, but major liquidity injections, because you have to fight this major, big danger of negative nominal GDP and then explosion of balance sheets at the government level, at the corporate level, at the bank level. So this is really and it resembles being a kind of frog that is thrown in a boiling pan. So when you have a dislocation, the investors, markets explode, and you are just thrown in a boiling pan. The current environment with more inflation that is dangerous for assets over the long term is more that we are in a boiling pan, but the water is tepid, it's getting a bit hotter, but it's going to take time before we get an impact on performance. And this is really where we are. And in that environment, the most attractive beta is not interest rates, but it is equities and risk-on strategies. Risk-on strategies and equities is, to our opinion, the best asset in an environment where you don't keep fighting deflation like we have done for the last 20 years, and that we engineer higher inflation.